Awesome. Yeah. So usually I start off most of these presentations with facetiously saying everyone's favorite topic, and it's like compliance or things like that. This actually might be everyone's favorite topic. So I'm going to walk through, some portfolio exits and distribution best practices. Let's see. The agenda, I'm going to go over some common types of portfolio exits, what kind of distributions they trigger. I'm going to go into, what the difference between in-kind and cash distributions are, pros and cons there, and help you make the right decision. And then go through some distribution best practices in general. And that's where I'll talk about like what your admin team can step in and do. So first and foremost, common types of portfolio exits. Obviously, there are the ones that we all know, which is mergers and acquisitions, secondary sales, tender offers, company buybacks. In most of those cases, you're going to get cash to distribute. That decision is super easy. And in M&As, depending on the type of company, you might get public shares, you might get more private shares, and you'll get an escrow, usually 10% of total proceeds, determining what to do with those cash and when to distribute. That's up to you. And that's where you're going to work with your admin team. The part where people get a little bit more, not confused, but there's a decision to be made is when one of your private companies go IPO, and those private shares now turn into public shares. And then it's, what do you do with those shares? And that's where a lot of people, they don't know if they want to distribute the stock to their investors and treat it as an in-kind distribution, or sell the shares and distribute proceeds and cash. So I put together a little pros and cons of both in-kind distributing shares and cash distributions, and we'll walk through them a little bit. So the good thing
about it.
I think that's just someone not muted. Anyway, so the good thing about an in-kind distribution, there are a few things. The actual distribution of those shares is not a taxable event. The tax gets deferred to when either the GP sells their shares that they get in the distribution, or when the LPs share. And a lot of the times you'll see it on the accounting books and records as a deemed gain as opposed to a realized gain. So that's something to keep in mind when you're determining, which way you want to go. The other thing is the value of that distribution is locked in. So the price of the shares may fluctuate after the distribution, but the distribution value is locked in at whatever your operating agreement says. So it could be, the last closing price. A lot of the times you'll see it be like the average of 3 to 5 days of the closings price, but that value is locked in, which is a good thing. And it removes the decision from the GP of whether or not they want to hold on to the shares, sell the shares, sell partial, and hold on to some for long-term value or long-term gain. It kind of just releases that burden from the GP and passes it along to the LP. And it gives the LP or your investors the autonomy to hold, sell, or, do a partial sell and hold it. So it kind of just passes the buck along to the LP, which also is a con depending on your LP base. If you have really savvy investors, they might like the idea of getting those private shares and then having the ability to hold or sell them, or they might not be savvy investors, and they would value you selling those shares and giving them cash. The good thing, again, that I mentioned before is that you lock the value of the distribution. The bad thing is if that stock increases in value over time and your LPs haven't sold shares, they're going to get more money for that than you were credited for. The same is for the reverse. So if the stock declines, you're locked in from a fund manager, but your LPs are getting less cash than what they got credit for. And one thing that I actually appreciated in a couple of in-kind distributions with some of my former clients is that they actually made the decision to sell the shares themselves or hold on to the shares themselves and distribute cash because they understood the companies intimately a lot more than your investors do. So they know, what the stock value could be or where it could be. They just have a little bit more information about what those private companies are doing or public companies are doing more than your investors do. Not necessarily a con per se, but you need to involve a broker. So they're going to be the ones that are, cleaning the stock, ready to have it be transferred. They're going to handle helping your LPs get set up with brokerage accounts and stuff like that. It's just another operational step that you need to be thinking of when you're going to do a stock distribution. And then the other option is you sell and distribute the cash. So the good thing is once you sell the stock, that value is locked in. Your LP's distribution on their cap accounts is the exact amount of cash that they're receiving. There's no appreciation or depreciation of that value. Cash is cash. that also takes the LP's decision away, which, like I said before, if your LP base isn't as investment savvy, that might be the right decision. They might appreciate that. And cash is king. Everyone likes getting cash. And then you can also have the ability to sell some of your shares and hold on to the other, and it gives you a little bit more flexibility in that aspect. The cons, so selling of the stock is a taxable event. The second that you sell the stock and you realize proceeds, you're going to have either a realized gain or realized loss on the books, and that gets transferred to not only the GP, but also your LPs. So just keep that in mind when you're selling stock versus distributing stock. So the other con is like the lost value if the shares appreciate. So if you sell your stock on day one and it doubles in value over the week, that's obviously one of those, oh man, I wish I held on to it situations, but you can only prevent so much. Which leads to the next part is you need to think about timing and get the timing right. So make sure you're selling at the appropriate time. You're not holding too long or too short, and you're timing out when you're going to get the most value for those shares, which then could be an operational burden for the GP. So you have to not only manage private stock, which doesn't necessarily fluctuate too much over time, you also have to kind of keep like a hedge fund mind in which you need to make sure you're timing the selling of those shares right. And these are some things that you should consider before making a decision. In my opinion, either decision is right. There's no such thing as a bad distribution. People appreciate getting shares. They appreciate getting cash. As long as you're sending them something, like make your LPs happy, that's the way to go. The other thing to consider is, when is your lockup period over? A lot of the times it's 3 to 6 months after IPO. Make sure that you're, depending on which way you want to go, you're planning ahead with your fund admin and your broker. If you're doing a stock distribution and you want to distribute those shares the day of lockup, you need to include those vendors sooner rather than later, so they can make sure that they have all of their ducks in a row to be able to facilitate those distributions. The biggest thing to think of, again, which goes back to the pros and cons of cash and stock distributions, is what would your LPs value most? The LPs are your customers. So if you think your majority of your base would appreciate a cash distribution and don't want to take on the burden of a stock distribution, that might be the way that you go, or vice versa. And then the other thing you want to think about is you don't have to take an all or nothing approach. You could distribute some shares, you could sell some shares and hold on to others. So you don't have to approach it as all or nothing. At the end of the day, whatever you think is best for your fund is the way that you should approach it. Like I said, there's no real wrong answer there. All right, this is the part that's going to be a little lengthier than this slide, but distribution best practices. And this is where your fund admin or your other vendors are going to come into place. The first and foremost, plan ahead with your fund admin team. Typically, no proceeds are coming by surprise. You know when a fund or a portfolio company is going to get bought out. You know when an IPO is going to happen, and even more so, you know when the lockup period's going to end. Just talk to your fund admin team. Make sure that they know, hey, I want to do a distribution. Here's the approximate time that I want to send out this distribution. I'm going to do it in cash. I'm going to do it in stock, et cetera, et cetera. That way that they can have the time to plan ahead for you, get preparing those waterfall calculations, et cetera, et cetera. It's always a best practice to loop in your tax team. So most people don't realize that there are actually 3 waterfalls associated with the fund. There's a distribution waterfall, which determines how much proceeds you get from a sale or a distribution of stock. There's the allocation waterfall, which is associated with your books and records, but there's also a tax waterfall. At the end of the fund, all 3 waterfalls will line up, but as you're running the fund, they might vary in different ways. So you could be in taxable carry without being in distribution carry. So that's why you want to loop in your tax team, because they might be able to say, hey, you should take a tax distribution from the GP's perspective, because you're going to get taxed 20% of these gains, but you're only getting 1% of the distribution. So we want to make sure that you have cash on hand to cover those taxes. And they'll be able to walk you through what that looks like. They also will be able to help you with QSBS verification. Most people will go hands up and say, I don't want to say 100% that this is a QSBS stock, but they'll be able to lead you in the right direction of whether or not you tell your LPs that, hey, this might qualify for a qualified small business stock. Check with your tax team, because that could have real tax implications. They could have 0 taxes versus 35% or whatever their taxable income rate is. First and foremost, or actually not first and foremost, but the most important thing you should do as fund managers, and on the flip side, what your fund admins, you should rely on them for, is understanding the intricacies of your operating agreement. What is your waterfall? Is it return capital 80-20? Is it return capital you have a preference amount, then 80-20? Are there catch-ups? Is it deal by deal? You should understand just as much as your admins what that waterfall looks like. What your admin is responsible for is turning those words into a calculation. The other thing you want to think of is, do you have a recycling limit? A lot of the times operating agreements will cap your recycling limit or your reinvestable proceeds at 110% of your committed capital. Just understand what that is, not necessarily so you hold back all of the proceeds, just so that you know what your options are when you're determining how much you want to distribute. The other piece is, can I hold back for expenses, which kind of plays into the sources and uses calc, so I'll go into that a little bit more. And then, am I allowed a recallable distribution? I used to say in venture that wasn't really the case, but I've seen more and more in operating agreements the ability for recallable distribution. And that just means you could send the money to your investors and then at a later date call that back, so you can actually call more than what your investor's commitment is. Again, those are all things that you should keep in mind as you're planning for your distribution. The sources and uses calculation. So that's just determining, if you need to hold back any proceeds for expenses, if you have any investments coming up, do you want to net this distribution against the capital call and send $0 to your LPs, but also give them credit for it on their capital account? And you should be able to work with your fund admin to determine the appropriate amount that you want to distribute. The other piece that I always suggest, and I actually just talked to an employee about this today, is always run the amount through your waterfall, regardless of if it's your first distribution, your 50th distribution, whether it's pro rata or you're in carry. You should have a waterfall created and calculated and run every single set of distributions through that waterfall, just so you know that you're following the code of the operating agreement and you're not caught off guard for if and when you do get into distribution carry. The other piece that you want to make sure is, I always suggest confirm with your investors their wire instructions at least every 12 months. That doesn't mean you have to do it every calendar year, but if you have a distribution, your first distribution, even if you have subdocs with wire instructions, confirm those wire instructions. If for the next 6 months you have another distribution, you probably don't need to confirm those wire instructions. But if you have a distribution 3 years from now, just send an email saying, hey, LPs, we're expecting a distribution. Just let us know if any of your wire instructions have changed. That is pretty much it as far as distribution best practices. I think I flew through